Hi there.
Hi.
All right. Thank you to everyone who joined in so far, and we look forward to welcoming more guests as we go along the program. Uh, I think markets didn't do too much today. I mean, they were volatile for a while, but then pretty much along expected lines. I don't think anybody expected big fireworks in the budget today, given that it was an interim one. However, it also sort of followed a very important event, which was the Fed meeting overnight. And therefore, today was seen as a day which could possibly be a pivotal moment for Indian markets, at least for the near term. I think broadly the budget seems to have delivered some good news because there were certain sectors that sprung towards the end of the markets today, especially. I think, Amnish, some bit of energy was seen around PSU banks and tourism, maybe because some of the stocks actually took off towards the end. There was also good news in terms of bond yields, sort of coming down by, I think, 8 to 10 bips, which was good news. We wouldn't be able to understand without your expert guidance on what exactly the budget meant. And the question, of course, on everybody's mind is that with such big news, the Ayodhya, temple creation, the budget going out of the way, the Fed meeting sort of getting over, what do markets look forward to in the next couple of months, and what is it that one should expect as trends? So we would appreciate if you could give us an overview of what you saw in the budget, a brief overview on the market situation as you look forward for the next couple of months at least, any key triggers, etc., right up to July when the final budget gets presented, and any other insights that you would like to share with us. And to all of you who've joined us, Amnish is Director Head of Institutional Research, a very knowledgeable person, acknowledged for his sound understanding of the Indian economic situation as well as demand supply economics across many sectors, including vital sectors such as FMCG, the capital goods sector, and so on and so forth. We would love it. If you have any questions, you could put them on the chat, and me or Nilima would love to take them up with Amnish. Amnish, over to you.
Yeah, hi. Thanks, Sandip. So, hi, friends. So, first, my take on budget. This year, the government has given interim budget. If you look at and if you can recall, 2019, the government gave full budget. And it was opposed that why just 2 months ahead of elections, they have given a full budget. And many people were thinking at that point of time that they tried to do whatever they wanted to because there was uncertainty ahead of last year election whether they will be winning the elections or not. But this time, as the situation stands today, I think government seems to be in a very fine fettle, particularly the NDA. Now, in this backdrop, this budget is an interim budget, and this is not I would say, the final budget by any stretch of imagination. And that is the precise reason why government has not tinkered with a lot of things, which include any changes in excise duty, any changes in personal or corporate income tax. So these are two vital things to note. Then, if you look at the fiscal situation, I think it is in absolutely good shape. Fiscal deficit at 5.8% is lower than what they had estimated in the beginning of the year. The tax collections, both on the direct taxes, that is particularly the corporate and personal income tax, has been very good, ahead of the expectations. Excise and custom duties have been soft, but because the direct taxes have been good, the fiscal deficit has been under control. Secondly, the net borrowings of the government, the total borrowings, they are lower than what they had anticipated in the beginning of the year. And that is another big positive, and that is why the government is indicating that next year, the overall money which they will be borrowing from the markets, that will be lower than what they did this year. So which means that there will be less pressure on the system and the liquidity overall will improve as we go along. Once these all elections, etc., they are over. In addition to it, I think they have not tried to disturb anything. And the budget seems to be indicating just the continuation of the policies which they were following from past few years. For example, if you say broadly the capex, so whether it is in, you can say, your green energy, PLI, so on all those things, the allocation has been increased. Now, if you look at the capex, 11% higher, but effective is 18% higher. And if you look at that, it is on a base which has been growing by 20% every year. So even this increase looks quite good. Okay, defense capex allocation is not that high, but I think particularly in some segments like your aircraft and all, the allocation has gone up. Similarly, I would say in case of then another, I would say the single biggest, you can say, focus, which is very clearly visible, is again on capital goods, whether it is railways, whether it is, you can say, defense or overall. So cap goods, infra, that seems to be the, you can say, the biggest pie of this entire, you can say, takeaway. That is one. Then you have got, you can see, increased allocation for Manrega, but I don't think it is now that much of a needle mover as far as your rural demand is concerned. Then they are indicating that they would be making 3 dedicated corridors for cement, okay, and other commodities. So we don't have full details of that, but that is, I would say, another positive which is there. So in addition to it, I think they are going to refurbish lot of trains on the lines of the interiors and all what is there on the Vande Bharat trains. So that will give lot of, you can say, incremental works to many of the companies. I think some of the other announcements were, for example, PM Awas Yojana, particularly on the rural side. So 2 crore more houses will be built under that. Then I think in terms of, say, sectors, these seems to be, I would say, the main crux of the thing. Some focus on, say, green energy was there. Okay, there was some, you can say, subsidy cut on, you can say, EVs, particularly two-wheelers. So I think these were, you can say, the main things. So nothing which is very significant or very stark, which I can say in terms of various sectors. If we look at it is, I would say, business as usual, whether it is PLI. So whatever was working on well in the past 2-3 years, the same continuity has been, you can say, maintained by the government. Okay, that is one. Maybe when the, you can say, the main budget comes, which might be mostly, I think, in the month of July or August, we can see some more allocation, some tinkering here or there, or some new schemes. But as of now, it is more like a status quo. Now, coming to what Sandip was particularly asking about, say, 3-4 things. One was on the bond yields and your Fed meetings. So what view we have got is that now, if you go purely by budget numbers, then government is in fine shape, their borrowings will be less. And so the pressure on liquidity in India will come down for sure. So which means that if your inflation remains under control, and if, I think the second aspect here comes from Fed. And because there is still no clarity on what will happen in US and Europe. Because in Europe, the recession is clearly there. In US, there is no big slowdown which is visible. So maybe at least for a quarter or two, Fed might not reduce the interest rates. Okay, but whenever there is a slightest of hint from the Fed on reduction of interest rate, which practically translates to maybe anywhere, if you look at from Indian context, sometime in 2Q or surely in the second half of the year, one can look at some sort of an interest rate cut to happen. Okay, and so once that happens, so that is why I think after yesterday, the bond yields also reacted there in the, you can say, reflecting that. The second, you were asking about particularly the, you can say, Ayodhya. Okay, now I think this is a very interesting sort of, I would say, scenario and study from the Indian context because of 2 things. One being that it is not only Ayodhya. If you look at Kashi, Ujjain, and Ayodhya, the tourist traffic or the number of, you can say, the pilgrims who are visiting those places, it has grown in disproportionate proportions, maybe somewhere 200%, 400% high. So that is likely to result in much more infrastructure development in those states, a big boost to GDP, consumption, tourism. So all the ecosystem around that is going to grow. So there is absolutely no doubt on that. And I think riding on the wave of, you can say, particularly this event, the government also seems to be now in a very, very fine shape because the opposition is crumbling each day. And now it seems very high probability that this government is going to come to power with reasonable majority. So this event, I would say, both economically, from the infrastructure angle, as well as politically, it is a positive for the government and for the investors also. I think the event is likely to give many more investing opportunities because there will be many companies which will benefit, whether it is tourism, whether it is infrastructure, airlines, railways. For example, if you try to connect Ayodhya to all the major cities by bullet trains, or if you are going to start, say, 35, 40 Vande Bharat trains reaching that particular destination, then definitely the companies who are making coaches, who are into rails, who are into creating those infrastructure, they are definitely going to benefit significantly from that. Now, the next thing was on the PSUs. So I think that is, I would say, a bit of tricky situation because PSUs was a bad word 1 year back. Now they have seen multiple rounds of re-rating. Many of these stocks are 5 times, 7 times, 10 times. So that many of the PSUs, for example, PSU banks may be still significantly lower than private banks, but some of the PSU other institutions, even OMCs or some of the other companies, they have seen massive re-rating, so much so that their multiple or valuations today may be a 10, 15-year high. Okay. So I think some of these have gone up because, for example, OMCs earlier, people were saying their terminal value is zero, but looking at India's growth, okay, now people have started seeing the terminal value of whether you can say any OMC or NTPC might not be zero because an NTPC might be now going into renewable energy also, the share of which might increase over a period of time. So while the easy trade in PSU definitely seems to be over, and from here on, one will have to be, you can say, more acting like a stock picker in PSUs because we just can't close our eyes and pick any PSU at this point of time because the stocks have rallied sharply from here on. Now, based on what you can say in terms of, say, triggers incrementally going forward, I think 2 to 3 things are worth looking at. First of all, definitely the corporate profits, which I think barring 2, 3 sectors, they have been just average. The second factor which needs to be looked at is obviously we are heading for elections. Okay, 2 months down the line, and whatever we might say, once the actual outcome comes, then there could be definitely, you can say, some exuberance around that. That is the second, and third is going to be monsoons, and fourth is the interest rates. So these are the 3, 4 factors which will be the key triggers, say, over the next few months. And overall, we continue to remain positive and constructive on the markets. The markets have given, I would say, very good returns over the last 12 months. So while the same stocks not be participating in the next round of rally in the same manner, however, we believe that some of the sectors where we have been very positive around, whether these are, you can say, capital goods, infra, engineering, then hospitals, pharma, housing, building materials, and some very select stocks in metals, discretionary consumption, or financials. So these are some of the, you can say, sectors which will continue to be in the limelight. In terms of, say, budget related, some specific stocks, if you ask me, companies like, say, BEML, okay, Jupiter Wagons, BHEL, Titagar, okay, then Paraj, Thermax. So these are some of the, you can say, companies which are going to clearly gain from some of the announcement. But otherwise, overall capital goods, engineering, infrastructure is going to be the gainer. Then maybe some Vari Energy, Tata Power because of that solar announcement. Then Siemens, ABB. So entire, you can say, cap goods will continue to do well. Whatever they are announcing on the logistics side, particularly your 3 corridors, maybe JSW, Adani, Concor. So these companies will benefit from that. Similarly, some of the building material companies, maybe say an Astral, or you can say even companies like your Pidilite, or you can say plywood companies, etc. So they are likely to be beneficiaries of this entire move. So I think these are the, you can say, some of the stocks which seem to be the direct beneficiary. Obviously, when the economy does well, the other ones will also benefit from it.
Thanks, Amnish, for a very quick. It was almost equally short as Nirmala Sita. So I was told that this was the shortest ever speech that she's given, at least. Versus,
Yeah,
I think,
because earlier it used to be 2.5 hours.
2.5 hours, right? So I think you sort of mirrored that. And I completely agree. There was broadly nothing except continuation of the trend, at least till the
Yes.
hump of the elections is over. Amish, before people sort of step in, I'll take the opportunity of being the host and therefore demand the first question from you, or the first response from you. So, Amish, the one thing that I can't get my head around is the fact that, you're seeing a situation where IIP is sort of decelerating. Corporate results have been sort of, I think, broadly for the first time. I don't know the number, but I think we are seeing more disappointments vis-a-vis expectations than possibly the previous few quarters. The international economy, I mean, even though inflation remains high, but the international economy clearly is sort of headed towards a deceleration, if not a recession. In that kind of a backdrop, why do you think the finance minister chose to tread a very light path on borrowings? I mean, doesn't that sort of go against the grain of how we see the economy evolving?
You see, as I said, there is a very clear trend which is visible. For example, if you look at, say, excise duties and customs, so the collection there has actually declined. Okay, maybe for example, there is some pressure on exports to Europe. Okay, so in some sectors there is some pain. But having said that, if you look at the corporate tax and income tax your collections plus GST, so all these three are in good double digits, ranging from say 11% to 14% growth. And the next year projections are also on the same front. Now, as I have been, you can say we have written also in our last strategy report, and I have been even voicing it even in media and other places, that today's underlying growth in the economy might not be fully reflected in the, I would say, the corporate profits of listed companies. Because if you look at, say, many sectors and core companies are not doing well, I agree. But at the same time, if you look at the government's GST collections and the corporate tax collections and the individual tax collections, they seem to be very healthy. So there is some sort of a disconnect. And that disconnect, in my view, seems to be because of the simple reason that there's a lot of growth which is happening in the companies which are not listed today. A lot of growth is happening in the channels of which the listed companies are today not the true representative. So that is why I am not that much worried about the corporate profitability. And that is why I think if you ask me in the next 12 months, I will be positive, but it is going to be a stock picker's market. One just can't close one's eyes and buy anything.
So I think, Amnish, we'd have to request you sooner or later to start a topics report even for the unlisted space, because you're right. The minute you mentioned developments around areas like Kashi, etc., the first thing that comes to mind is, of course, smaller entities, much smaller entities doing probably about 100, 150, 200 crore kind of turnover. Very, very geography specific, but possibly very, very profitable because of these developments. So we'd love to hear your stock picks in that segment sooner or later. We won't push you today for that. The other bit, Amnish, the way I understood the budget is that there was something about the manufacturing subsidy being taken away. What implication does that have? Or does it have any implication at all?
Manufacturing subsidy.
Yeah, there was a tax subsidy which sort of extended a 7% benefit. There's a small announcement which came on one of the WhatsApp groups. I don't know whether it has a large implication, but so if you're not sort of
still looking at, say, some of the finer details, but as of now, I think none of our team members has highlighted any.
So maybe I overestimated the impact.
We are
The
still
last
looking
thing,
at, if we come across, then I will convey it to you.
sure. Uh, my final question, the FOMC overnight came out sort of sounding extremely disappointed with the way inflation is headed in the US, right? And we all thought that incrementally, maybe the language would turn slightly more dovish, but he seems to have made a couple of statements which, so I've been wondering whether 6 cuts or 5 cuts or 4 cuts, which is what the markets are anticipating, and possibly is behind the momentum that we are seeing across the globe. Is it likely that if inflation is so high in possibly February, no visibility of deceleration? I mean, how do you sort of estimate 6 cuts in a matter of, let's say, 6 months, July, August on? Is it realistic or is it
I
being
think it
too
is,
optimistic?
if you ask me, it is daydreaming. 6 cuts in 6 months. Because you see, we are living in a very uncertain geopolitical environment, and the entire, you can say, world today. For example, in the last 1 month, we have seen Houthi rebels. Houthi rebels, they are now attacking the, you can say, your ships in the Black Sea. Now that adds to cost, that impacts the exports, and that further can lead to inflation as well as lower global growth. When there is an uncertainty, so events like this will continue to keep the inflation and growth, both these parameters on the tenterhooks, till the time some of these irritants, whether it is Russia-Ukraine war, whether it is Israel-Hamas situation, or whether it is, you can say, attacked by these rebels on the ships in the Black Sea continues. And the way this entire geopolitical situation is panning out in parts of, say, Europe, in the parts of Middle East and all, and the way it is spreading to these regions, I think in the next 12 months, we are going to see a very uncertain and deteriorating geopolitical situation. In that sort of a scenario, my sense is that expecting that first of all, Fed will start from, say, Feb, and then they will continue cutting for the next 6 months. That, in my view, seems to be slightly too much of an optimistic scenario.
Got it. Amnish, we'll open the floor for questions. I've got one question, which is a very, very obvious question, and we know that you've been actually on track vis-a-vis this stock, HDFC Bank, because I remember you telling us a couple of years ago that this is one stock that's possibly being overwhelmingly overrated and one should be extremely cautious. What now?
You see, the one reason and where I think entire market has gone wrong is that HDFC Bank was running very high credit to deposit ratio. Obviously, due to, you can say, merger. Now, two things can happen. For example, if your credit to deposit ratio is higher, either your deposit rate has to increase significantly.
Yes.
Or and to accelerate that, if you pay higher interest rate to the depositors, then your margins can come under pressure, or incrementally it can start impacting your growth after a while. So either of these two things can, you can say, happen with HDFC Bank in the near to medium term. If you look at, say, any analyst, they will say that earlier we had assumed 16 or 17% growth, we have reduced by 100 bips. So the kind of balance sheet HDFC Bank is running, if you have to reduce the, say, credit deposit ratio by, say, 10-15%, even over the next 2 years, 1% doesn't matter. It has to be, say, more deacceleration in growth than 1%. And that is what, in my view, the stock price is reflecting. But having said that, HDFC Bank, in terms of its technology, in terms of its distribution and network, it is one of the, it's the largest private bank and overall one of the best in the country. So I think in the near term, there don't seem to be many triggers in the stock, but maybe now, maybe you can say if it corrects slightly more, it's a good stock to look at, but with one caveat clearly that one will have to be very patient to make money in HDFC Bank. Because now the bank has got 14% weightage approximately in Nifty. Okay, so it's a very, very big heavyweight. So many of the funds actually will not, they can't increase their holding beyond 9 to 10%. So that is one. The second is this entire balance sheet correction, whether it happens with HDFC Bank or any other bank at any time. So it always happens very gradually, and with the kind of size HDFC Bank is having, it is not likely to happen, say, in the next 3 or 6 months. It will take its own course.
Okay, Amnish, Tejinder is asking, what are your top 2 or 3 sectors that are likely to perform well over the next few weeks and months?
You see, few weeks is very, you can say, hard question for me because I usually don't get into few weeks kind of a scenario. But as I said, that this entire space of capital goods, infra, engineering, so that is clearly one space which we refer to as capital goods and engineering. I think it has done well and it will continue to do well. So that is clearly one. The second is where I'm structurally very positive for the medium to long term. That is your hospitals. This space has been doing well. Some of the stocks they have done really well, and my own you can say liking has been Max Healthcare, and I think it will go places even from current levels. Then some of the you can say other sectors, because you see today the problem is that the markets are not cheap. Okay, and in this kind of a scenario, you will not find many sectors where the valuations are not high. Okay, but even then, for example, if you look at say uh, a sector like consumer durables, so it's down in the dump from last 2 years. So if this entire you can say 300 units of somehow subsidized power or solar or whatever the government is talking about, if that money gets available, so definitely I think the usage of consumer durables can increase. Okay. So I think this is, I would say, another sector. And I think beyond that, if you ask me, I would be more like a very having stock picker kind of a situation and not go specifically by any sector in particular.
Okay, Anish, there's a question which I'm sure you would not like to respond to, so I'll possibly rephrase it. The question that's there is, what's the view in February for the markets? I'll possibly twist it slightly. You've been meeting a lot of institutions, right? So have you seen any sort of caution, incremental caution, or a very pronounced kind of shift away from a risk on mode? Do you sense any incremental caution that we should
Okay.
be sort of taking into account
You
while
see, I will tell
deciding
you
what?
one parameter which every investor can follow very easily, and that is your SIP inflows. Last calendar year, we had 1,83,000 of SIP inflows. Now, when institutions are getting 15,000 crore per month of inflows, and this excludes the pension schemes, this excludes any PF money or insurance money, and if you put together everything, the inflows actually will not be 15,000 crore, they might be say 25, 30,000 crores. Now, if you look at say last calendar, that is your calendar 22 in particular, or say last 18 months before this rally, FI sold stocks worth I think 1.5 to 2 lakh crores. You remember 10 years back. If FIs would have sold even 5-10,000 crores, the markets will be down by 20%. The kind of selling which was there for 1.5 years, the markets didn't go up, but they never went down. So the leeway of the domestic investors, you see, institutions are also a function of the retail money reaching the investors. And these are not, and I'm talking just about, you can say, mutual funds. If you look at, say, a lot of AIFs coming, lot of other avenues coming, I think today the kind of domestic inflows which are there in the family offices and all these, so that actually points to the fact that the medium term outlook, okay, you see, a month or two, the markets can be jittery, they can react due to some reason or the another. But if I look at, say, next 6 to 12 month kind of a view, and it is what I think our Nifty target is 24,000 plus. Okay, and my sense is that if, first of all, we get a government with good majority, if the monsoons are normal, okay, and if the interest rate cuts, they start happening, then I will not be surprised that over the next 12 months, we will comfortably surpass our Nifty target, which is, I think, around 24,500. We will comfortably surpass that. So that should give you some, you can say, idea.
Oh yes, absolutely. Very optimistic. So thanks for that, because if you had not said that, we would be very worried about what to do. The next question, Amnish, is a very quick one on how do you look at the metal sector from where we stand right now?
Okay, see, metal actually it has to be placed in several buckets today. For example, you have got non-ferrous companies like Hindalco, which due to, you can say, the global, how they are positioned, what they are making there, they are in a very fine shape. Then you have got the non-ferrous. Non-ferrous prices also have been soft globally. And secondly, the exports from India, they have not been that lucrative as they used to be in the past. And the third bucket is the users of metals, like for example, pipe companies, okay, or the, you can say, who are not basically making metal on their own, but who are doing some
Converters.
value-added work. So the converters actually are doing far better than the first two buckets. Okay, so incrementally, I would say that maybe in the near to medium term, very difficult to take a call on many of these large metal companies per se, because they have had a rally also in the past. But I think converters today, they are doing well. And if you go by the kind of infrastructure work which is happening, I think converters can continue to uh, see incremental growth in profits at a pace higher than some of these large companies.
Any names that come to mind? Top one or two?
Sandeep, very difficult for me to give you names in these at this point of time.
We won't hold you accountable.
No, nothing like that. You see, Hindalco is one stock in large cap which looks good. Among converters, we don't have any coverage or
Correct.
any stock. Personally, I have not gone into that much of depth that which I can, you can say, call it.
Any view on L&T? The shares have increased considerably. They are direct beneficiaries on the infra spend at current levels. Does it make sense?
Look at L&T, whether it was Trans Harbour Link or a temple in Ayodhya, you look at any great building being built in the country today, 10 years back, 20 years back, and 10 years forward is the L&T which does. Now, incrementally, they are getting the benefit of the huge order inflow which they are getting from their energy or oil and gas segment from Middle East. Now, in terms of order book, they are very well placed. The legacy orders where their margins are lower, they are going to end. And today, if you look, nearly 1/3 of SOTP of L&T comes from the IT services, which till now they have not been doing well. So if you look at last 6 months or so, the stock has rallied by more than 20-25%. That is why post results, it has shown some correction also. If you ask me in the next 2 months, very difficult to say. If you ask me over the next 1 year, this stock can incrementally give you easily 15% or even 20% return.
Fair enough. I think that's a pretty confident answer. Amnish, looking at this scenario, is there a re-rating of PSU banks possible?
You see, it is not that they have not got re-rated. The difference is that earlier many of the private banks were trading at 2.5, 3 times price to book. PSUs were at 0.5. Now, in that 2.5, 3 has actually gone down to something like on an average from say 1.6 to 2.4 kind of a range. And PSUs have, the large ones at least, they have reached 1.2, 1.3 kind of a number. Now, the gap between today and ICICI Bank and SBI, it is considerably lower than what it used to be earlier. So that actually just because that gap has reduced considerably. But PSUs can give you, in my view, more compounding returns from here on, because a stage will come when the money will again start moving a little bit towards the private banks. So they are not, I would say, an absolutely kind of a sell, because in terms of technology, in terms of some of the other aspects, they have improved a lot. But at the same time, it is not a trade where you can now make 2x or 3x from these levels.
Sure. Amish, do you have any views on OMCs as a community and Castrol India?
You see, Castrol, I haven't looked at in the, I would say, in the near future. But having said that, in the long term, this company has not given any volume growth. Okay, because of 2, 3 reasons. And one big reason is that over the last 10 years, the market has moved towards the synthetic oils. In case of synthetic oils, the life of the engine oil is far more. So that is why you don't get much volume growth. It has been a margin play. And as far as my memory goes, and that is why the company has not done anything great, and neither the stock has gone given any returns except in phases when there is, you can say, market exuberance, and then the stock gives you return. Because I'm just looking at last 5 years, it's a hardly 10% return which has come from this stock. And if you look at say 10-year period, it has actually given negative returns. So I think it is more like a trade which is playing out, but definitely for the long-term investors, I don't think there is anything significant in this stock unless and until I'm missing out on something.
And OMCs?
You see, OMCs have seen a very sharp rally, and as I said earlier, that people were not assigning any, you can say, great value or the terminal value in these stocks. Okay, but having said that, I think some of these OMCs, they have done well. The numbers have been good. But again, like I said about the entire your PSU space, here also I think many of the stocks, they are at lifetime high, closer to that. They might have moved up, say, even 150 to 100% from the bottom. So the return expectations in OMCs should now be reasonable if one is making a fresh entry.
Any view on whether we should be booking profits in the railway sector?
You see, if you ask me, railways, there are 2 or 3 things happening. First, on the cargo side, like they announced today that they will be making 3 new dedicated corridors. Okay, for 3 different commodities, I think, which includes cement is there, steel is there, maybe one more is there. The second is there's a massive, the government is looking at, you can say, increasing share of railways in the overall freight movement in the country, in the overall cargo movement. Because in India today, only 25% of the goods move through railways, whereas the cost of moving them through railways is at least 35% lower than roads. And that is why their target is that over the next 10-15 years, this ratio has to move from 25% to 45%. So which will require making these kinds of corridors and investing massively in railways. Whether these are, you can say, bogies, whether these are rolling stock, whether these are infrastructure. So a lot of investment is going to go into this. The second is on the passenger side. When you look at that, there will be, for example, bullet train might not directly add. You look at Vande Bharat, you look at some of the other initiatives on the passenger side, definitely railways is going to see much more investments than what we might have seen in the last 10-15 years. Now, when it comes to the railway stocks, actually there are 2 or 3 buckets in which you can place them. For example, you have got some of the railway engineering companies like your RVNL is there, IRCON is there. So that is one basket. The second basket is some of the companies which are, you can say, doing the, basically one is your EPC company, and second is the equipment companies, and third is the locomotive companies. So my sense is that particularly the EPC companies have seen a very sharp rally. And even some of the other, you can say, equipment companies have seen that. But as far as your growth and financial performance is concerned, I think railways as a segment, particularly if this current government continues, is going to do well over the next 5-10 years. There is absolutely no doubt about it. For example, the companies which are focusing, say, on Kavach, okay, where you had today 68,000 kilometers of railway lines. Kavach is there, I think, in hardly 1,000 or 1,500 kilometers. Next year, 2,000 kilometers might be added. After that, maybe 5,000. It means at least it will take 5 to 10 years for the existing railway network to be covered. Similarly, you look at, say, for example, the companies which are into railway signaling, railways automation, which are making rolling stock, bogies, companies. For example, Siemens India got a huge order few months back, okay, from railways. They are into Kavach also. So you will continue to, you can say, get these companies making incrementally profits. Now, valuations, you see, whenever there is an exuberance, you will always have some phases where the stocks might run ahead of the, you can say, fundamentals. That can't be ruled out. But if you ask me in the medium to long term, I think railways is a theme. I can't say that it has played out fully in terms of the financial performance. In terms of stock, I think it will be a very stock specific game. But if someone is looking at, say, buying a large cap stocks in railways, for example, today's due to this announcement, I think BML has gone up by 10%. But a stock like Siemens, I think, where we are very positive, I think this stock will unlock huge value over the next 2 years.
So what you're essentially saying is that these are dramatically transforming sectors, and therefore using conventional metrics of price rise, etc.,
Yes.
is possibly not the right way to look at it. Divide it into segments and see where,
You
because
see,
government policies are
segments,
changing dramatically.
Sandeep, we have to look at one particular angle, which I think many of us and investors particularly miss out. That word is changing. The technological changes which are happening today, many of these are happening maybe say after 80 years, 100 years.
Decades,
And
several.
globally, there are very few companies which are on the forefront of this technology. And many of these, you can say, for example, you look at whether these are railways, locomotive, whether these are, you can say, all your ecosystem related to this energy transition. There are 5 companies broadly globally. Your Siemens is there, ABB is there, Hitachi is there, Mitsubishi is there, Schneider is there, GE is there. Now, what happens that whenever the big technological changes happen, so these companies and their subsidiaries are going to benefit. So that is how I think I will approach this entire capex. That you will have some conglomerates which will benefit, you will have some niche companies which will benefit, and that is how I would like to identify some of these companies. Because what is happening in India today in terms of infrastructure, whether it is railways, solar, or any other thing, maybe solar is a new concept, but in terms of infrastructure, in terms of capex and all, it happened, say, in Japan 40, 50 years back, it happened in Korea, it happened in your China. And when such like things happened in those countries, you have got, I would say, humongous amount of growth for 10, 15 years. So if this entire story about the government talking about being a developed nation to 2014 plays out, then I think
Final question. Radhika is asking, if the Modi government fails to come to power, what is the sign for the market, bullish or bearish?
okay, you see, the main thing is that why the markets have done well, or what is the positive about the government being very realistic, is that it was a majority government with no clutches. Okay, no crutches were there, and that is why they were very good in decision making and taking hard decisions also. Now, if we presume the condition today that if in any case this government has to go out of power, then you will have some, you can say, party, maybe with 50 seats, 100 seats, supported by 15, 20 other people. Each one of them may be having 15 seats, 20 seats, 25 seats to the contribution. So such kind of a fractured government at the center will not be able to steer the way the things are today. And if that happens, for once, the markets are definitely going to react. However, the kind of work which has happened in this country in the last 10 years, maybe the markets will react first. After that, they might rebound like what happened in 2004. Because even in the 1999 to 2004, there was massive amount of work done by the government, which helped markets sustain momentum for the next few years of the economy. Plus, there was global tailwinds which were there, okay, which are not today. The tailwinds are not there. So even if the government doesn't come to power, there could be, say, some momentum, carry forward momentum, maybe say for the next year or two. But definitely over the medium term, then we are going to see some sort of a stagnation that can't be.
That's a nightmarish scenario. We wish that the Indian society doesn't have to see fractured mandates like that anymore, irrespective of which government is in power, etc. But thank you so much, Amnish, for a very quick, insightful, and a very optimistic view that you've given us. We will, of course, be sending out the budget note as soon as it's out from Amnish with his picks. And you can always write into us at our email ID, advisorydesk@plindia.com for views on portfolios. Thank you, everyone, for joining the call. And thank you once again, Amnish, for doing this for us.
Thank you.
Thank you so much.